Classic start to a meeting on mute. Thanks for joining today. You probably can hear that I've almost lost my voice, but I think I've got enough voice to talk about the budget for half an hour and how it might help you guys. Um, so hopefully you can all hear me okay. I'll just share my screen and we'll get started. So we're going to try and record the actual presentation part. If there's any Q&As at the end, I might just stop the recording for that period, in case anyone's details are in the questions, that sort of thing. So you can read literally hundreds of articles about the budget. I don't really want to get into politics. Everyone has different opinions, and that's fine. I just want to present the changes in a relevant way and as simple a way as possible, and try to focus on suggesting actions that you might take to avoid the bad changes and to benefit from the good changes. So the areas I think are worth covering: um, simpler personal tax returns. That's a positive change. CGT changes the negative gearing. That's most of the content of today. Trust tax changes. So should you avoid using trust in the future? And what if you've already got one? I'll be very quick on company tax improvements. There's not a lot to say there. And just at the end, SMSFs, no news is good news. So nothing big changed in super, but because a lot of other structures got worse, super is comparatively better. So let's start with the personal tax returns. There's the two standout things are the standard deduction of $1,000 and the $250 working Australian tax offset. So let's start with the $1,000 deduction. It doesn't mean you get $1,000. It means you can claim $1,000. So when does it start? So not this coming tax return. So there'll be a lot of misunderstanding. People just putting $1,000 of deductions on this year's return, and then kind of forgetting that yeah, that the rules don't start till next year. In any case, who does it help? It helps workers who have nothing to claim, or who have nothing to claim outside the exceptions. I'll give you some examples. It also helps workers who don't want the hassle of tax record keeping. So if I'm doing my tax, I reckon I've got $1,100 of receipts, but I can just claim $1,000 without having to find them. Fantastic. It doesn't help sole traders, trusts, and partnership structures, but they already get an inbuilt tax offset, so they're not losing out. And what's the saving? Well, nothing if you're already claiming $1,000. Nothing if you're in the bottom tax bracket. Up to $470, but that would only be if you're in the very top tax bracket and you currently claim nothing, which is unusual. So what are the key facts? You can claim $1,000 of work deductions, even if you haven't spent it, even if you don't have receipts. So under the old rules, you need to incur an expense, you need to substantiate the expense, so have records, and keep it for 5 years. None of that's required, which is really great. You can't claim all your receipts and 1,000 on top, with some exceptions. And there's a lot of things you can still claim separately, which I'll cover next. So I'll give you three examples. Say this is a classic public servant situation. All you've got to claim for the year is union fees. That might be $850. Because that's an exception to the $1,000, you can add 1,000 on top and you can claim $1,850. So you've just suddenly got a bit of an extra tax refund. Let's say you've got receipts for $800. Can you claim now $1,800? Add the $1,000 on top? No. So it's not 1,800, it's not receipts plus 1,000, it's topping up to 1,000 in total. And what if home office is your only deduction? So classic example for my tech company workers, everything's paid for apart from their home office. If you think about the fact that the ATO allows 70 cents an hour, that roughly equates to 46-week working year, 4 days at home. That's roughly going to be $1,000 deduction anyway. And I know a lot of you guys hate doing the work from home diary or tracking internet bills and all that sort of stuff. So if you just want to claim it, if you work from home 4 days a week, nothing else to claim, just put your $1,000 and you're just as well off. I think that's a great win for a lot of people. So what can you do about it? So if you run a business and that business pays you a wage, Um, Pay everything you can from your business, and then just claim the $1,000 on your personal tax return. So then you're getting all your receipts are actually claimed in the company or trust, however you're structured, and you get the $1,000 deduction on top. The second thing, I think the main thing, is to know what's separate from the $1,000. So still claim your donations, your income protection insurance, last year's accounting fees, your investment expenses, that includes rentals and shares, and your union fees or professional memberships. You want to claim all of those. Um, the third thing um, would be from July 2026, if you don't think you're going to have more than $1,000 of receipts, you don't need to keep records anymore, which is fantastic. And you might even like to do your personal tax return yourself. Save on our costs there. Um, the working Australian tax offset, I've called it a big nothing burger. It's 2 years away. It's automatic. You don't need to claim it. You don't need to know anything about it. It'll just be added to your refund. It's a lot less than inflation will cost you in 2 years' time. Um, the only slight thing you could do is some business owners don't pay themselves a wage, so they won't be eligible for this. They might want to consider to start paying themselves a wage. Then you get the $250, but that's very small. And I think there's other topics that might interest you guys more. Um, so CGT changes. So we've got our old rules. We've got the 50% CGT discount, which applies if you hold an asset for 1 year and 1 day or longer. And then that's taxed at whatever your tax rate is for that year. So the two things that have changed are how to calculate a capital gain and the amount of tax on a capital gain. So the capital gains discount is gone, but you can adjust for inflation instead. And there's a minimum 30% tax, which impacts low income earners. So when do the new rules apply? From 1 July 2027. So not the tax year that's about to start in a couple of months, but the one after that. Um, even for pre-CGT or pre-1985 assets, which is surprising. So we don't have grandfathering here. We actually have ungrandfathering of pre-CGT assets. It doesn't matter if you owned assets on budget night or not. If you sell before the rules change, use the old rules, the discount method. If you purchase something after the change, you have indexation, the new method. If you own something through the change date, where it overlaps 1 July 2027, we have transitional rules. So I think the best way I've understood it is just in a diagram. So here we are now. There's the end of the next financial year. And here's the financial year where this kicks in. So if you sell, so say you've got a pre-CGT asset, which I know some of you have, very old properties normally have been in the family for a long time. Those are still exempt up until if you sell prior to the change. You still get your discount if you sell prior to the change. If you buy after the change, it's the new rules, and there's a minimum 30% tax. The exception is new builds. So you can choose which of the two tax methods works out better for you if you build a new residential property. But other than that, it's going to be the new rules. So what if you hold assets now and you're not going to sell them till the rules change? Well, you're still exempt on your pre-85 assets and you still get the old rules on your post-85 assets. So nothing will change. And there's indexation after that. So say you sell your asset here, here at the end of that period, right? You will work out your capital gain in two parts. The part that happened here with the old rules and no minimum tax, and the part that happened here with the new rules. So if you have a share investment, you can look up on the stock exchange what the shares are worth on the 30th or on the 1st of July 2027. But if you own a property, you're going to need to get a valuation for that asset on the 1st of July 2027. It doesn't mean you need to get the valuer to do the valuation that day because there are a lot more properties in Australia than there are valuers. So that will be impossible anyway, all right? But you do need to get a valuation, not necessarily until the time you sell, because valuations can be done retrospectively. There's plenty of data on the market for that. But what you don't want to do, well, actually, I'll come back to that on another slide. So who wins out of this? I actually think long-term asset holders win, because if you adjust for inflation over time, the CGT discount is actually less generous than the current rules if you're holding for 10 years plus. Um, who loses? I think the biggest loser is pre-85 asset owners who've been ungrandfathered. So their CGT exempt properties that they legally owned under the current law suddenly are taxable. Um, Low income earners are losers in this, unfortunately. So say you've got a one income family, dad's at work, mum's at home, they sell a rental property, mum's on a low income because she's not working. The tax rate for low income earners on wages, zero, interest, zero, dividends, zero, partnership profit, zero, but on capital gains, 30. So minimum taxes, I don't actually understand the government's logic on this. They only can affect the bottom two tax brackets. Everyone else is already paying more than 30, so I'm not sure how um, this is helping us go after high income earners if that's what they're trying to do. Um, but anyway, that's what they've done. And as I say, it's not about politics today. Um, who else loses? Investors who make a capital gain over 12 months and under 5 years. So the people who benefited the most from the old rules were people who held shares or property or whatever for 1 year and 1 day, because suddenly their tax is halved just for that one extra day. So the CGT discount, I think, is a misleading name. It was never a discount in terms, it wasn't a gratuitous tax break. Um, it was a way of adjusting for inflation without going through complicated inflation tables. And yes, it was generous for short-term investors, um, to encourage more investors, I guess was the logic. But actually, it's been worse for long-term investors. So because of inflation, Australian dollars have halved in value, according to the Reserve Bank, halved in value from the year 2000 to the year 2025. So if you doubled your money in that 25-year period, you've actually made nothing adjusted for inflation. So the CGT discount was very unkind to a very long-term investor, very generous for a 1 year and 1 day investor, and somewhere in between about 7 to 10 years, it was about right. Um, so I've actually run some examples of how that would work on various scenarios. I might skip those just in case I don't get to the other content. Um, but a good question to ask is, should I sell assets before the CGT change? And my answer will be no, or at least not for tax reasons. So the transitional rules mean that you revalue your assets at that point anyway. So you still get the CGT discount for your post-85 assets. Any growth to that point is still tax-free for your pre-85 assets. So selling and repurchasing or whatever won't make a difference. For your pre-85 assets that might be in a company or a trust, or you want to move it to a different structure, okay, maybe that's a good time to do that. But for other assets, no, doesn't really help you. Um, you want to get a valuation on the 30th of June to maximize your discounted gain, right? So for your pre-CGT assets, whatever value you get here, that's your starting point for capital gains. And for post-CGT assets, that's your starting point for arguably a higher capital gain system. But either, whether it's pre or post 85, the higher that value, the less tax you pay. So you can't just get an estate agent to put some um, pie in the sky, pretend over generous valuation. That would be the ATO could just throw that out. But at the same time, you don't want to use the council rates notice, which tends to be a bit under the market price. So you want to get the highest legitimate valuation you can. And given the professional valuations, um, there'll be so many of them that the cost will come down. Already they're less than $600. I think it's well worth getting one done. As I say, you don't need to get it done in July 2027, but you do need to get it done to do the calculation properly. So what else can you do about the CGT changes? Well, you can take advantage of existing rules. So for example, you're a young person wanting to buy your first property, um, or even an older person, the way that people buy properties later in life now. But you might want to buy a property to rent out. Consider living in it first. So say you live in a property for 1 year and you rent it for 7 years. So you've owned it for 8 years in total. 12.5% of that time you lived there. 87.5% of the time you didn't. But there are special rules for homes becoming rentals. The first special rule is you get to reset your CGT cost base when the home becomes a rental. All right, so you don't, any gains that have happened from when you bought it to when it becomes a rental, they're exempt. And if the gain's exempt, it doesn't matter if it's a discount or indexation method. That's the first special rule. That's an automatic rule. The second rule you can choose to use or choose not to use, and that's called the absences rule, or colloquially the 6-year rule. So you can call a former home, you can treat it as your main residence for CGT purposes for up to 6 years after you move out. So living in that property, and just by the way, the 1 year is not, the legislature doesn't say you must be there 1 year. It could be 6 months, for example, but this is just an illustration. It can't be like 2 weeks. It has to be like, this was genuinely your home. You moved your furniture in there. You slept there. You told Vic Roads. You told the electoral office, all that stuff, right? Even though you've lived in it 1 out of 8 years, it's exempt from tax for 7 out of 8 years. So that's the existing rule that becomes more appealing if you're expecting capital gains tax rates to be higher for you. So that's the second thing you can do. Also, by buying a property, if it's your first home, you can save some tax using the first home super saver scheme. You might have stamp duty concessions as well, depending on your state and how much you're spending on that property. So I guess there are non-CGT reasons also to live in it for a while before it becomes a rental. So yes, it's majority CGT exempt, even though the majority of its ownership was a rental. You can also hold your rental property or your investment portfolio, because we're not talking about properties only. We're talking about properties, shares, gold bullion, crypto, um, excuse me, any CGT asset, all right? So why would you hold a property in a company? So my colleagues at Mitchell Wilson have been helping people structure their investments in companies rather than trusts and individual names for quite a few years. And there's a few reasons why. So um, franking credits, that's the first one. So if you pay personal tax, that's gone forever. If a company pays tax, it's not paying tax for itself, it's paying tax for the shareholder who ultimately gets the profit. So when companies pay tax, that gets set aside for you in what's called a franking account. So your tax is credited towards the company, and when the shareholders get the money eventually, tax credit goes with it. And the reason for that is if you didn't credit the company for the tax, shareholders would pay double tax. So they would lose more than half the profit by the time it got through the ATO's hands. So it's not some special magic trick, it's just a way of avoiding double tax. But what this means is you can spread out income from a company over time. So the company makes a profit, pays its tax, but the individuals pay the final tax, as I said. So if you look at an example of, say you're working, you're on 39% tax, and you're also a landlord, you've got a rental property or a share portfolio. You sell that, so you retire, then you sell it in the year that you retire. People would do that because they would be on a low tax rate in retirement. The 30% minimum tax kind of spoils that, but nonetheless, you're working, so you retire, sell down your assets, maybe invest them in your super fund. Especially if you're age 60, right? But then if you're retired and living off super, your income from supers doesn't count for tax. So your taxable income's zero. So you've got over this years 3 to 10 here, over this last little period, you got all your income's lumped into 1 year, so the tax is high, and then you pay no tax, no tax, no tax. But you can't average it out. You can't use the zero tax threshold from these years and put it into those years. If you're a company, the tax is the same every year. All right, so how do we make this work? Let the company pay tax when the asset is sold and then pay it out to yourself over time, because in the bottom two tax brackets, the tax rate is less than 30, but you've got a tax credit of 30%. So in this bracket, you get 30% back. In this bracket, you get 14% back. So normally when you get more income, you get more tax. But for low income earners, if you get more dividends, you get tax back. So if you take this scenario, um, investment property owners retire, they sell their rental, make a capital gain, $200,000, 100 each, minimum tax 30%, that's 60 grand, that's gone forever. But if the company have it in a company, that company pays the tax. The company can then pay them a dividend, not all at once, but over the next 7 years. And each year, this couple won't earn more than the tax-free threshold. So they're getting back after the seventh year, they've actually gotten back nearly all of the tax, all by taking advantage of their tax-free threshold. And the way to do that is a company, spreading out your income. One thing where the Australian tax system really penalises people is by having a one-off year of high income. It doesn't matter that they don't normally make that much. Um, that never gets factored in, other than farmers and certain obscure professions that have special rules. But you can't average out your tax. But a company can let you achieve that. Um, yeah, achieve that averaging. So what else? A company's maximum tax rate is the same as a new minimum CGT rate. So under the old rules, so if you look at the last two columns, so here and here, um, companies had a low tax rate, but they couldn't get the CGT discount. So they didn't have a low CGT rate, right? So companies had the worst rate of CGT under the old rules, but companies have the equal best rate of CGT under the new rules. So suddenly, with this one change, the company structure, which already had those benefits I described, is even more favourable because it's no longer a worse option for holding CGT assets like properties and share portfolios. There are a few other benefits of a company. You might pay less land tax. It's a separate legal entity. You can still negatively gear shares, but I want to move on to negative gearing before we wrap up. So negative gearing has got a lot of attention. Um, Overblown in my opinion. I don't want to get too much into opinion, but sorry, let me just call. All right. What's different about the changes, right? So negative gearing, we have grandfathering. So if you're already doing negative gearing, if you owned a property before the budget night, you're fine. Capital gains tax, there is no such grandfathering. Just have those transitional rules I showed you. Negative gearing changes are targeting one asset class, and that's residential property. Whereas capital gains tax changes are targeting residential property, commercial property, Bitcoin, gold bullion, shares, ETFs. And they both start 1 July 2027. So the negative gearing changes are impacting a much narrower group, I guess is my point there. So established residential property. Another thing people were worried about is, oh, why should I include my income but I can't include my expenses? Well, you still can include your expenses. Losses are not disregarded on a rental property. They're quarantined, which means you can still use them, but only against rent or the sale of a rental property, the capital gain on the sale of a rental property. So they're not gone. They're just, the tax benefit is pushed into the future. So to put it graphically or just in a picture, um, before budget night, it doesn't matter what asset class. After budget night, um, if it's residential, doesn't count. But new residential, or most new residential, cover Y, commercial, shares and ETFs, um, you can still do negative gearing on all of those. So what's the new build exemption? Um, Essentially, if you're increasing the housing supply, you can still do negative gearing. So what's in that category? Build on vacant land. You had 0 houses. You've got 1 house. You've increased the housing supply. You're in. Um, Knock down and build a duplex. So you took 1 house out of the housing supply, but you put 2 on. 1 becomes 2. You've increased it. You're in. If you knock down rebuild, replacing 1 dwelling with 1 dwelling, 1, you haven't increased it. You're out. If you're the second owner, so a property might have been built last year, the first owner owned it for 1 year, sold it to you, you're also out. You have to be the first owner. Um, Very quick side note, because I don't want to take too much of your time, but new builds, especially off the plan apartments, are the asset class where I've seen clients lose the most money, apart from maybe FX trading and CFDs, which I would call financial poison. But why have new builds really been created a bad outcome for my clients? Um, Oversupply. Developments are going to be dozens of apartments, hundreds of apartments, or dozens of outer suburb new estate dwellings, which are mostly the same. So when you go to sell, there's lots of supply. Buyers have lots to choose from, which means that puts the buyers at an advantage and keeps prices down. Supply and demand is against you if you've got a lot of the same product. Um, Unfair contracts. I could tell war stories on that, but I want to keep moving. Um, but suffice to say that the contract is written by the builder in the builder's favour on a take it or leave it basis. You can't negotiate the contract generally. Um, Dodgy build quality. You just see the number of places in Melbourne with flammable cladding or in Sydney with water ingress is just amazing. And you get the body corporate bills for 20 grand, 30 grand. It's astonishing. And property spruikers, the dodgiest people in the finance industry, adding markups to the builder's price and acting like they're giving you a bargain. It's just, I'm not saying anyone selling a new build is dodgy, but so many of them are. So, like, I'm sure there's an honest politician or an honest car salesman somewhere. But anyway, um, another side note, a colleague of mine who's got close ties to the mortgage broking industry, banks are already factoring in the changes when they're assessing how much money your rental will cost you or make you. And because they use that cash flow, so your cash flow from work and your cash flow from investments, that's how they work out if you can afford the loan that you're applying for. So in other words, borrowing capacity for landlords will be lower because they're already factoring in the new rules. So negative gearing, what can you do about it? Most people who are interested in negative gearing are people who are already doing it and they're grandfathered in. So there's nothing really you need to do about it. Um, but let's say you're a prospective rental property purchaser. Um, Consider property through super and SMSF. It's still legal, it's still relatively easy to do. If you get the structure right, which we can help with, it's not as hard as you might think. If you've got $300,000 in your super and you're interested in doing that, um, yeah, happy to talk you through the pros and cons of that. And you've got the tax benefits we'll talk about later as well. Um, you might diversify into other asset classes. You might have invested in rental properties up to now, but you might then invest in a commercial property or even a listed commercial property trust on the stock market to save having to pick one property because it's harder to do than buying residential. You might diversify into shares or ETFs instead. It's subject to clarity on the rules. You can't use negative gearing to offset your salary as a future investment, residential investment owner, but you most likely can use you can use the losses on a second property to offset the rent on your first property because we're expecting losses will be quarantined not against one property, but against your whole rental profit and loss together. And that way you're still using your losses. And again, subject to clarity on the rules, um, the legislation will clear this up. It's expected that the grandfathering applies if you own the property before budget night, not that it was a rental property before budget night. So if you have a existing home that you want to convert to a rental and still has quite a sizable mortgage, you could still use negative gearing most likely. Let's move on to trusts. Trusts seem to be the most heavily hit category um, in this budget. And the main reason is discretionary trusts, which are also called family. So family trusts are discretionary trusts, will have a minimum tax of 30%. It won't apply to fixed trusts, super funds, which are technically trusts, and widely held trusts. They're all fine. The target is private family wealth, which, whether deliberately or not, targets small and medium businesses and mum and dad investors. So if you have a trust and you're already distributing to middle and high income earners, which we talked about, right? No change to the tax payable because we talked about the top three brackets already pay more than 30. So who cares if the minimum is 30? Who loses out if your trust distributes to a low income earner? The tax is significantly higher to the point it is not worth doing. So these rules don't abolish the use of trusts, but for many structures, they make them useless. If you distribute profits from a trust to a company to shelter it from tax, that won't work anymore. So you still can do it as long as you're happy to pay 51% tax, which you might as well distribute to yourself because the worst tax you can pay personally is 47. So again, not outlawing these things, but making them so unworkable that people will change their structures. So again, like with capital gains, I'm a low income earner. Maybe it's your adult child who's at uni, or maybe it's the stay at home mum or a sub-funded retiree. Um, no tax on wages or interest or dividends or partnership profits, but 30% tax on trust profits. So you've suddenly been replacing the tax you should be paying with an arbitrary 30%. Where would this hit people? Let's take you've got a small mum and dad business, makes 120 grand a year, not a fortune, and splits the profit 50-50. Um, the tax on, if it's 30%, is $36,000. But if you pay normal tax rates, so you have the exact same people, exact same company, sorry, exact same business, exact same wealth, exact same everything, the tax under normal rules in 2028, 29, um, be about 19 grand. So it's close to double, which is insane. And I'm not sure whether they didn't think that through in the changes, or they don't care, or this is an unintended consequence. Not sure. Or they want to get rid of trust stop, maybe. Don't know. Um, one slight tweak to that, what if the mum and dad company, say they're running a takeaway shop and they both work in the business, they just pay wages of 60 grand each instead. That's the 120 grand trust profit is now nil. So the trust tax doesn't apply. They go back to paying the normal rates of tax, and in fact slightly less because of the working Australian tax offset and the new $1,000 deduction. Um, so there's a simple way around it for a business trust, but not for an investment trust. If I've got a trust that's got a share portfolio, maybe a rental property, I can't pay myself 60 grand for managing that, let alone 60 grand for me and 60 grand for my wife for managing it. So investment trusts will find that harder to do. But if these changes go through, people will just restructure. Um, so should I close my trust? Maybe, but not now, because this is not law yet. It's just an idea until it's gone through Parliament. And there's a thing called a restructure rollover. So the government, to help people, they're saying, we're going to make trust a terrible structure, but we understand you've already got these things set up. So we're going to let you move all the assets to another structure, say a company or just to your own names, that would normally trigger tax and CGT. A rollover means you can make that transfer and they'll rewrite the rules to exempt you from the CGT. So if you think about the timing of this, right? So here we are now in 2026. 1 July rolls around in about 6 weeks, 5 weeks time. Nothing changes. 1 year from now, the rollover period starts. So the new rules don't start till 2028, but your ability to restructure starts a year before that. So for some of my clients, changing out of their trust, all right, it would be better under the old rules, and for others to be better under the rollover rules, whatever they're going to be. So the time to consider reevaluating your discretionary trust is just before the rollover starts. So I would just business as usual for another year. Um, I'll just briefly touch on this because we're almost out of time. Um, Investment companies, is this the trust alternative? So that the accounting industry, um, nerdy and clever as we are, have already thought about, well, what can we do? Why shouldn't families who've run a business, because a lot of your business owners, you know how hard that is. Um, why shouldn't a business be able to share the profit among a family? Um, the way they've done that in the past is trusts. Why shouldn't they do that? So how could we do that without, if trusts have a minimum tax? Well, companies don't have a minimum tax. Um, and partnerships don't have a minimum tax. So I haven't got a slide on this, but if you're earning income from a business and genuinely as a mum and dad business, it could be that one of you does most of the work as long as you both do the work. So it could be, um, you're a Sparky, your wife does your books and your quotes and your invoicing. So you're actually both doing work, even though it might be 90% him and 10% her in the work. The ATO has okayed the use of a 50-50 partnership, which is a massive tax advantage, but not if you've got a company and not if you've got a trust. So partnerships for your service type businesses like that um, could be a much more attractive structure now, right? In fact, they already have big advantages. They have one big disadvantage in a trust with a company as trustee, or in a company, that business is a separate legal entity to your personal assets. Whereas with a partnership, it's not. So if your partnership gets sued and your insurance doesn't cover it, it's your home, your cars, your personal assets on the line. So I wouldn't say, hey, we should all have partnerships because it requires both mum and dad to be working in it, and B, a willingness to take on some legal risk. But anyways, that's for your service businesses. What about for your passive investment companies where you might have held a rental property, commercial property, share portfolio, um, crypto, gold, whatever CGT assets you've got? If trusted targeted companies aren't, could we not have a company, let's call it Investco, where mum and dad are the directors, so they control the company. Mum and dad hold ordinary shares in the company. So these ordinary shares have the right to vote, so they control the company. Um, they control the capital, so if the company winds up and sells its assets and passes them on to the shareholders, just mum and dad get those. But say a mum, dad, son, daughter family, um, we could have A class, B class, C class, and D class shares. Now these shares can pay dividends, but they don't control the company. So if we thought, for tax reasons, we want to gift our son um, 40 grand because he had a low income, he's just um, heading off interstate for uni and needs to gonna find a flat and pay some expenses. We could give him that money and he would pay normal rates of tax because it's coming from a company, not a trust. And the following year, the daughter goes off to uni, and so we pay a D class dividend for her. So um, we still get to choose. 1 year, one person gets more. 1 year, another person gets more, which is why we use trusts. Maybe this is how we can still do that under this new regime. Again, I would give it a year. Um, Let the profession nut that out. Products will be released that have these structures. If it's once we know the legislation, once it's been thought through, and once people start to react, yeah. So that's an interesting. There are going to be alternatives, but I think waiting a year is wise. If the exception would be if you're just starting an investment structure, so, or you've got a trust that you just set up recently, but you haven't started investing yet, then you might want to consider alternative structures now. Otherwise, wait till May, June next year, find out what the best alternatives are, which will be very clear in 12 months' time, and then act. Um, Company tax improvements, there's not a lot there. The first one is not just for companies, so that was a bit misleading, but um, you can write off assets buying a business without having to apply depreciation up to $20,000. It's been that for a lot of years, but it's been a temporary $20,000. And each year the government decides if they'll extend it one more year or not. They've now just said it's 20 grand, it's permanent. We're not going to muck around with the rules. So there's no new tax advantage, it's just simplified. Um, Companies that make a loss can carry back that loss. And that was a temporary COVID lockdown rule. Um, that's coming back from 1 July 2026. And if you're a startup from the 2029 financial year and you meet certain criteria, you can actually get a tax refund on the losses of your startup. But as long as you're employing people, because you have to have paid tax on wages or fringe benefits tax, both of those require employees. So not any company can get this loss tax refund, just companies who employ. Um, yeah, I think the loss carryback is the best of those rules. It really, sometimes you might have one good year, one bad year. If it's a bad year followed by a good year, that's fine. You average the two out. If it's a good year followed by a bad year, you can't. But this rule now says that you can, which is great because businesses can fluctuate. And it's just a little bit of help for small business. Um, Last little topic. Um, Self-managed super funds, no news is good news. And not just self-managed funds, but all super funds. Um, Superannuation is the king of tax structures. So tax on income for a company or a trust will be 30%. For an individual, up to 47. Super funds only pay 15% tax on capital gains over 1 year. There still is a super fund CGT discount that hasn't changed. So you're only paying 10% tax on capital gains. Imagine that compared to on a rental property or a share portfolio in super. If you sell assets in super in retirement, there's no tax. And there's no tax on the income, tax-free dividends, tax-free interest, tax-free everything. So low tax now and no tax when you're 60. So it makes superannuation the king of tax structures. So that hasn't changed. Um, it is possible if you overlap the financial year to get $500,000 per person into super. So if you're in a situation where you had $1 million invested outside super, say you were 59 and a half, you actually get $1 million between a couple into super in short order. And then whatever changes happen in 2027, what do I care? Or you could do that $1 million a year from now, as long as you get your timing right and factor in the capital gains calculation. So yeah, super is still the king of tax structures. Um, so what works and what doesn't work? Um, Trusts holding investments doesn't work unless you know that trust is always going to give money to people who are above 30% anyway. So say the example of a couple, you have a trust, they're both high income earners, they know they always will be, they can keep their trust. But for anyone else where you're using the trust to try and share income among a family, including maybe low income kids at uni or stay at home mums or self-funded retirees, they don't work anymore. Trust running a small business don't work. Um, you could pay wages to overcome that, but you're better off restructuring 12 months from now. What about holding assets in the lower earner's name for our one income families? Um, that still works and it doesn't work. So it doesn't work for capital gains because of the minimum tax. So say you own some shares or ETFs and you have a stay-at-home parent, you put the assets in their name, they'll still pay a high rate of capital gains tax, but the dividends and interest, etc., along the way, um, yeah, they will be um, still taxed at a low rate. So holding assets in a lower earner's name still works, especially if it's interest where there's no capital gain. And even if there is a capital gain, um, you're still overall better off, even though the new rules make you slightly worse off. It's still better than having joint names. It's still better than having it all in the higher earner's name. Um, Negative gearing still works, except for future residential properties that aren't new. Um, Holding assets for at least 12 months um, to get the CGT discount is irrelevant after 2027, July 2027. You still need to hold it for 12 months to do indexation. So if you hold it for 11 months, you get 0% inflation adjustment. If you hold it for 12 months and 1 day, you get 1 year's worth of inflation adjustment. There's a tiny benefit, but not the benefit of the old days of the discount. Um, and SMSF still work, and super still works. Um, yeah, so just a few different scenarios that might apply to you, um, which I probably won't have time to cover. So I'll stop sharing my screen and I'll stop the recording.